There is an important update that every American needs to hear, and it could be the difference between saving thousands of dollars or losing thousands without even realizing it. Major changes are moving through Congress right now, and they affect healthcare premiums, senior deductions, and Social Security benefits in ways that most people have not been told. The information is not based on rumors, not speculation, and not clickbait headlines. These are real developments coming directly from Congress, and understanding them could protect your income, your benefits, and your financial stability. Many people glance at headlines and assume they know what is happening, but what is actually occurring behind the scenes is far more serious and far more urgent than most realize. Across the country, millions of Americans rely on healthcare subsidies to keep their insurance affordable. For the last several years, these subsidies have significantly lowered premiums for people using marketplace coverage under the Affordable Care Act. Without these subsidies, premiums would be so high that many people would simply be unable to afford coverage at all. Experts have already warned that, if these subsidies expire, monthly premiums could rise from a few $100s to several $100s more. For some households, premiums could double or even triple. For anyone on a fixed income, those increases are not simply inconvenient. They are financially devastating. Lawmakers from both major parties in the House of Representatives have acknowledged the seriousness of this situation. A group of members announced that they would force a vote to extend the subsidies. A forced vote is unusual because it bypasses the typical process and pressures leadership to take action. A discharge petition reached the required number of signatures, meaning enough lawmakers demanded that a vote happen even though the speaker opposed scheduling it. When lawmakers defy their leadership, it usually means they are hearing intense pressure from their constituents back home, especially from people who are terrified about their healthcare costs skyrocketing. The vote scheduled for early January is for a clean extension lasting 3 years. Clean means there are no controversial additions, no hidden items, and no political bargaining chips attached. It is simply an extension of the current subsidies as they are, nothing more. That simplicity makes it easier to pass in the House, but the Senate remains a much harder battle. In the House, nearly every member of one party plus a few from the other can pass a bill. In the Senate, it is different. Senate rules require 60 votes for most legislation, not a simple majority. That means both parties must cooperate, and convincing more than a dozen senators from the minority party to support an extension will not be easy. To break down the numbers, the Senate includes 47 Democrats and 53 Republicans. Even if every Democrat votes in favor of the extension, they would still need 13 Republican senators to support the measure. That is a high bar, especially in a chamber where members frequently vote along party lines. A few moderate senators might support it, but reaching 13 would require convincing far more than just moderates. It would require persuading conservative senators who typically oppose expansions or extensions of government subsidies. The situation becomes even more complicated when considering how the health insurance market functions. If subsidies expire and millions of people drop their coverage because they can no longer afford it, the risk pool becomes smaller and includes fewer healthy individuals. When healthier people exit the system, insurance companies face higher risks and higher costs. They respond by raising premiums for everyone, including people who receive coverage through their jobs. So, even those not using marketplace insurance could see their premiums increase. It becomes a domino effect that spreads across the entire system. The truth is that the American healthcare system has been broken for a long time. People in the United States pay more for healthcare than almost every other developed nation, yet they do not receive better outcomes. Medical companies and insurance providers continue to raise prices, increase premiums, deny claims, and create confusing policies that even trained professionals struggle to interpret. Meanwhile, ordinary Americans are skipping doctor visits, rationing medication, and falling into medical debt because they simply cannot afford basic care. Both major political parties acknowledge that the system is dysfunctional, yet they have not reached agreement on how to fix it. The debate over subsidies is just another reflection of that larger problem. While the future of healthcare subsidies remains uncertain, there is some good news for seniors who rely on Social Security. Several changes have already been passed into law and will soon begin taking effect. These changes include a substantial deduction for seniors and an adjustment to benefits for millions of people who were previously receiving reduced payments due to outdated rules. Understanding these changes could save seniors thousands of dollars during tax season. One of the biggest updates is a $6,000 deduction available to Americans aged 65 and older. This deduction is already law and applies to tax years from 2025 through 2028. It is a temporary deduction tied to a recent legislative package, and unless extended, it will expire after that period. Seniors who qualify can deduct $6,000 from their taxable income. Married couples where both individuals qualify can deduct $12,000 in total because each partner can claim the deduction separately. This could significantly reduce or even eliminate federal tax liability for many seniors. To illustrate the impact, consider this example. For someone in the 12% tax bracket, a $12,000 deduction reduces their tax bill by more than $1,400. For someone in the 22% bracket, it reduces their taxes by more than $2,600. That is real savings that can help seniors who are dealing with rising prices, higher medical costs, and limited incomes. However, there are important conditions. This deduction applies to seniors whose modified adjusted gross income exceeds $75,000 for single filers or $150,000 for joint filers. That might sound surprising because many people assume that higher income seniors would not receive additional deductions. But the purpose of this deduction is to offset taxes paid by seniors who cross certain income thresholds and therefore become subject to taxes on their Social Security benefits. More and more seniors are reaching those income levels due to pensions, withdrawals from retirement accounts, Social Security benefits, and investment income. Many seniors who previously owed no taxes are now finding themselves unexpectedly taxable. In addition to the $6,000 deduction, seniors may also qualify for an additional deduction of $2,000 for single filers or $3,200 for married couples filing jointly. This deduction has existed for years, but becomes even more beneficial when combined with the new legislation. When paired together, these deductions can dramatically reduce taxable income for seniors, especially those who are being pushed into higher income brackets because of required minimum distributions from retirement accounts. Another factor affecting the 2026 tax season is the increase in the standard deduction. For tax year 2025, the standard deduction is $15,500 for single filers and $31,500 for married couples. In 2026, those numbers increase again to $16,100 for single filers and $32,200 for married filers. These increases, combined with the new deductions, give seniors more opportunities to reduce their taxable income. Another major change that seniors need to be aware of is the repeal of two provisions that previously reduced or eliminated Social Security benefits for certain retirees. For decades, the Windfall Elimination provision and the government pension offset reduced benefits for people who had a pension from work that did not pay into Social Security. Many of these individuals were teachers, firefighters, police officers, and state employees. Even if they had worked other jobs and paid into Social Security for years, their benefits were still reduced. This created financial hardship for millions of people who had earned those benefits through years of work and contributions. The new law eliminates these provisions. As a result, more than 2 million people will see their benefits increased. Some retirees have already reported receiving retroactive payments worth hundreds or even thousands of dollars. Others have seen their monthly benefits increase by hundreds of dollars. For retirees living on fixed incomes, these changes are life-changing. They finally receive the benefits they earned without being penalized for having a pension. However, higher benefits can also create tax complications. When total retirement income increases, more of it may become taxable. Some seniors who previously had untaxed Social Security benefits may now find that a larger portion of their benefits is subject to federal taxation. This is why the new deductions are so important. They help offset the tax liabilities created by the increase in benefits. Seniors who understand how these rules work can legally reduce their taxes and keep more of their money. As the 2026 tax season approaches, Social Security recipients will begin receiving documents that outline their total benefits for the previous year. These forms, known as SSA 1099 or SSA 1042S, will be available online shortly after Christmas and mailed out at the end of December. Reviewing these documents carefully is the key to making sure the correct amount of taxes are paid and that no deductions are overlooked. Many people make the mistake of assuming that Social Security is never taxable, and that assumption costs them money or creates issues when they file. These changes together form a complex system that affects nearly every senior in the country. Healthcare premiums, Social Security benefits, deductions, and income thresholds all interact in ways that can either save or cost retirees thousands of dollars. Staying informed is the only way to make sure you do not miss deductions, benefits, or opportunities to lower your tax burden. These issues matter because they affect real people. They affect retirees deciding whether they can afford medication. They affect working families who fear losing their health coverage. They affect people who have spent decades contributing to a system and want to make sure they receive what they earned. Whether or not healthcare subsidies pass, the Senate will have enormous consequences, not just for those on marketplace plans, but for the entire healthcare system. Many seniors are already planning to use the new deductions to reduce their tax liability, but many others still do not know these deductions exist. That is why it is so important to share this information widely. Helping parents, grandparents, relatives, and neighbors understand these changes could save them thousands of dollars. Families deserve clarity, not confusion. These laws are complicated, but when explained in plain language, they become easier to navigate. The coming year will bring significant changes in both healthcare and Social Security. Some changes are uncertain, such as whether subsidies will be extended. Other changes are guaranteed, such as the new deductions and the repeal of outdated Social Security reductions. Knowing the difference can help people prepare for what is ahead. Staying informed ensures that you are not caught off guard by rising premiums, unexpected taxes, or missed opportunities for savings. These updates are not merely political debates happening far away. They influence the monthly budgets of millions of Americans, including seniors living on fixed incomes, families balancing expenses, and individuals trying to maintain access to basic medical care. As more information becomes available, it will be crucial to track developments closely and stay prepared for whatever comes next. The goal is not to create fear, but to provide clarity and understanding so that people can make informed decisions that protect their financial well-being.